Hey traders, let's take a look at how we can calculate the expected price range of movement of a stock. This range shows us how much the market makers expect a stock to move over a certain period of time. This will likely be at the expiration date we are considering for a trade. Range is based on the implied volatility of the stock and various options. Implied volatility is higher for events such as earnings, for high volatility stocks, and if we are looking to trade further out. All these lead to a larger range of movement and offer more expensive options prices. As a seller, high options prices are a benefit. The easiest way to calculate the price range is using the at the money straddle. A straddle in this case is looking at a call and put option average of the bid-ask spread of a stock closest to the current strike price at the same expiration date. Let's look at an example using Boeing. We're in Robinhood and looking at the Boeing options chain. You can see the Boeing current price, 205.11. We can select an expiration date for our trade. Let's stay with May 23rd. We can look for the closest price to the current price in the options chain, which is 205. And if we expand the row, we can see the bid-ask spread. In this case, we are looking at the call strike price. We can calculate the mid price between the bid and ask by adding the two values, 2.73 and 2.87, and then dividing by 2 to give us 2.8. We can then do the same for the put strike price. We switch to select put and open the closest price in the options chain, which is the same 205, and the row is expanded. We can see the bid-ask spread. We calculate the mid price between the bid and ask for the put in the same way as the call by adding the two values, 2.28 and 2.44, and then dividing by 2 to give us 2.36. Now we take the two midpoint values of each bid-ask spread, 2.8 and 2.36, and add them together to give us 5.16. This is the amount of movement in dollars the market expects the price of Boeing to move up or down by expiration. We now take the current Boeing price, 205.11, and the combined midpoint value, 5.16, and add them together to get the upper range price of 210.27. We take the current Boeing price again, 205.11, and the combined midpoint value, 5.16, and subtract that to get the lower range price of 199.95. We can use this information when placing a put credit spread so we remain outside the projected range of movement. We can calculate the expected range of movement as a percentage by dividing the expected range, 5.16, by the current price, 205.11, and multiplying by 100 to give us 2.51%. I hope you found this useful. Ask any questions you have about range of expected movement or straddles in the group chat, and I will see you for the next video.